Good afternoon and welcome to the July edition in our supply chain management webinar series. A few housekeeping things before we get started. If you have a question during the webinar, use the icon to raise your hand. If I pick up your question at that time, I'll try to answer it during the webinar. If not, stick around. After the webinar concludes, I will stay on the line as long as I need to answer your questions. Also, this webinar, as our other webinars, will be available to you later on this afternoon on our website. It'll be a YouTube video. So with that, let's start talking about getting control of inventory costs. What we're going to look at this afternoon are three specific items: the types of inventory cost, how you calculate your average inventory cost, and techniques to lower these costs. There are many different types of inventory costs, but today we're going to focus specifically on the cost of carrying material in inventory at your facility. So I'm going to put you to work right away. I'm going to launch this poll. I've given you 5 choices here. I want you to identify the 3 items that make up the cost of carrying inventory at your location. There are only 3 of them. So take a minute and make your choices. Which ones are costs you incur to carry inventory in your plant? Okay, I've got most of you voted so far. Still a couple people. And I'm going to be closing the poll in about 10 seconds, so make your final choice. Okay, here we go, closing the poll. So here's what you all said. 100% of you picked storage cost, 70% picked capital cost, and another 70% picked risk cost. Those 3 items account for the cost you incur to carry inventory at your facility. Capacity-related costs and purchase price costs are other costs of inventory, but not the ones that we're going to be talking about today. So let's talk about these 3 carrying costs. Capital cost. This is the cost of money. If you have to borrow money, if you have a line of credit that you use to buy inventory, it is the interest rate that you pay on that loan. If you have cash in the bank, capital costs are the cost of using the money to buy inventory versus possibly investing that money in a more lucrative, quicker investment that would get you more money for the dollar. So capital cost. Storage cost. These are the ones that we typically associate with carrying cost. The building that it's in, the equipment that you need, the people, all of those type of things are the cost of storing the material. Finally, you have risk cost. These costs are broken down into several areas. Obsolescence. If you buy a part and your engineering department designs it out of your product, you've just wasted money. If your product is damaged by a leaky roof on some of these summer rains that we've been having, or if it is susceptible to being stolen, or another risk cost is the insurance that you pay to protect against these things happening. So we have 3 types of costs that go into the cost of carrying inventory at your location: capital cost, storage cost, and risk cost. an example of how we use that information. There is a formula that says that carrying cost is the cost of capital plus the cost of storage plus the cost of risk expressed as a percentage. In this example here, capital cost is 10%, storage cost is 8%, risk cost is 7%. What this says is for every dollar of inventory in this location, it costs you 25% of that dollar to store it for 1 year. So if it's $1 of inventory, you store it for a year, it costs you actually $1.25 to have that inventory on hand over a year period of time. So we've looked at the types of inventory cost. Now we're going to talk about calculating average inventory cost. If you have an item that you purchase, in this example, 3 times a year, and when you purchase it or build it, it doesn't make any difference purchasing or manufacturing it. It costs you $1,000. You start out with $1,000, you use it up over time, and when you use the last dollar of it, or the last piece, you're down to $0. In this example here, we started out at the beginning of the year with $1,000 of this item. At the end of the year, 12 months later, we had none. So the average inventory calculation, how much did it cost, is your beginning inventory, $1,000, plus your ending inventory, $0, divided by 2. In this case, 1,000 plus 0 divided by 2, $500. That's the average amount of inventory we will have on hand at any particular time of this item. And it costs us now, if we do the calculation, if it costs us 25% carrying cost on that average inventory of $500, to carry that $500 of inventory for 1 year cost us $125. All right, so now we've looked at the types of inventory costs and how you calculate your average inventory. That average inventory, by the way, I used an example of one item. You can use your entire inventory to calculate that. So if you had $10 million of inventory at the beginning of the year and $5 million at the end of the year, it's 10 plus 5 divided by 2. Your average inventory is 7.5 million. Now, in supply chain management, we are always being pressed to reduce cost. And what we're going to talk about for the rest of this presentation are some techniques you can use as supply chain managers to lower these costs that you incur carrying inventory. And we are specifically going to stay with the carrying costs. There are other cost reductions that can be done. You can do purchase price reductions. You can become more efficient manufacturing things. These are other ways to reduce your inventory cost. But for this discussion, we are talking strictly about the cost of carrying inventory. So at the top of the slide here, you see the example that we just finished working where we bought the item or purchased or procured it, produced it 3 times during the year, and our average inventory was $500. If we reduced the lot size that we either purchased it in or manufactured it in, we would buy it more times per year, but our average inventory, as the bottom graph indicates, our average inventory would be less. So if we were buying it in $500 increments, our average inventory, using the same formula we used to calculate what our average inventory was in the previous slide, our average inventory would be $250. Do the math. $250 times 25%, rounded up, is $63 to carry the same amount of inventory over the course of a year. We have not, in this example, decreased our usage of this inventory. We have only minimized or reduced the quantity that we buy or build at any one time. Now, this always brings up the question of, well, if I do it in smaller lot sizes, I will have more transactions. Therefore, I will spend more money to do it in smaller batches. The key here is, and I'm going to separate things we purchase, and then I'll talk about things that we manufacture. If we're going to reduce the lot size that we buy stuff in from our vendors, there are three costs that we have to reduce internally to make that financially viable. We have to reduce the cost that we incur to place a purchase order. And I will give you an example of how we have progressed on this in the past 40 years. When I started in purchasing back in the 1970s, it cost us $1970 to place one purchase order, whether it had one item on it or 5 items on it. If you look at your cost to place a purchase order today, it is it's most likely about $35 in today's dollars. If we were still doing things the way we did in the 1970s, it would most likely cost us several $100s to place a purchase order. We have used technology to help us reduce the cost of ordering. The other costs that you have to work on are receiving costs. How much does it cost to receive the item and put it into inventory? And how much does it cost to pay the invoice? I have a client that has made an art out of reducing those costs. They receive the material directly to the production line. There is no receiving report done. When they use it in production, that sends a signal to accounting that we received it, we've used it, you can pay the invoice based on the terms that procurement has established with the vendor for paying the invoice. So they have literally done away with a receiving department, with people putting things in stock. The vendor delivers it to the stocking location, and the payment of the invoice is done as a byproduct of the production process itself. So reducing lot sizes of purchased items, you have to tackle these three costs to make it financially viable. Now let's talk about production. The big one in production is setup time. How long does it take to get the piece of equipment ready to produce the first good piece? If you have a setup time of 12 hours, you're going to run as many parts as you can before you break down that setup. If you have a setup time of 5 minutes, you have the option of setting that machine up, tearing it down, setting that machine up, tearing it down, much more easily and frequently, because it doesn't cost that much. So setup time reduction is the key focal point in reducing manufacturing lot sizes. In addition to that, you also have to look at things like material movement. If when the job comes off of the machine, it has to wait 5 hours for a material handler to come to move it to the next work center, because the next work center is 100 yards away in a manufacturing facility, that's an opportunity to try and get the next work center to be moved right next to the output of this work center. I know we're talking about capital equipment there, but these are the things that you have to look at when you're trying to reduce movement. Labor reporting is another key area. If we're running in lot sizes that take a day to produce, and we get the setup reduction down to where we can run in hour increments, the manufacturing people are going to tell you that you've just increased their labor reporting by a factor of 8. Again, we can use technology to do the labor reporting. Scanning in using barcode data collection or RFID updates to the computer. Actually, as the material comes off the machine, it gets scanned and updates the work order and the labor reporting. These are all techniques to use technology to actually make the labor reporting not something that the operator has to physically do. It's done as a part of the operator running the piece in the work center. So these are a couple techniques for lowering your inventory carrying cost. And as I said earlier, if you want to try to reduce your purchase price or reduce or increase your efficiency, those are other things that you can do to reduce your inventory cost. But this webinar specifically was talking about how can we reduce the carrying costs. Okay, well, thank you very much. If there are any questions, I'll hang around and answer them now. If not, hope to see you next month when we are talking about how to figure out what the right amount of safety stock is. Okay, thank you all very much. Any questions?